What's going on, everybody? So today we're going to be going over high resistance versus low resistance liquidity runs, and also why chart patterns or retail patterns do not work. Okay, so this is basically going over price's current condition and the algorithm's intention on what it wants to do and how it's going to react to current market condition. All right. So in this example, we're going to be going over high resistance liquidity first, okay? So with high resistance liquidity, there is going to be a multitude of different factors that will play to account of having price have high resistance liquidity. So when you think about the word high resistance, right? You think about, say, like a rubber band, right? You're having resistance against something. When you think about weight training, you're having resistance against yourself. You're having force pushing against yourself, with gravity pushing against yourself. You're just having something going against yourself, basically. So when you talk about high resistance, we're thinking about the market pushing against us. All right. So when you think about it, think about like weight training. Imagine yourself under a bench press and you're doing a 1 rep max, right? And you're struggling because you have so much weight pushing against yourself. Also, you got gravity pushing against yourself, and you're trying to push back as hard as you can just so that you can get the weight up. That's the same thing with trading. You're trying as hard as you can with the market to get to your designated, POI, point of interest, or your designated target, which would be buy side or sell side liquidity, right? Or an inefficiency in your case, maybe. So, with high resistance liquidity, just imagine it's the market pushing back against you really hard. Okay, so this comes with multitude of different factors. Okay, so the first one, we had swept external liquidity. Okay, so we had swept external liquidity. So that's meaning if this is external right here, this is a higher time frame PDRE or sell side liquidity had been swept. We can anticipate high resistance liquidity could occur. It might not not occur, but it could still occur. So it might not occur, it could occur. It might not occur, it could occur. It's a 50-50 chance. But that depends on all the other factors that add on top of it. So first, sweeping external liquidity. That's the first step. So if we swept it, we have a 50-50 shot of it being a high resistance versus low resistance, okay? Number two, we have zero engineered liquidity. Now we got to go back to the original roots of our mentorship program here, okay? What is engineered liquidity? Engineered liquidity, okay, when we engineer liquidity, right? We engineer liquidity. It'll look something like this, okay? Sorry. If we engineer liquidity, if we're engineering liquidity, right? It's going to look something like this. Market's going to come up, and then we're going to come back down, and then we're going to engineer buy side if we are going to be bullish in this scenario. We have multitude of buy side liquidity to be taken out. Every time buy side liquidity is taken out, that's liquidity added into the current expansion move. So every time buy side is taken out, it could retrace, but it's not going to be a deep retracement. It's always going to be a short one. So it's going to come up, maybe have a short retracement, and then it's going to come up, maybe have another short retracement, or it could just continue going up. So that is what engineered liquidity is, when it's engineering buy side and sell side liquidity to you, okay? So with engineered liquidity, that's an example of engineered liquidity. Another example of engineered liquidity is going to be a retail pattern. It is going to be equal highs and equal lows. So it's going to be looking like this. Market might come down, tap into something here, maybe like a fair value gap, maybe, and then it's going to take out that engineered liquidity here. Same thing when you have equal lows, right? Same thing when you have equal lows, it's going to look like this. Market trades down, creates equal lows here, might come up a little bit higher, tap into something here maybe like an order block or fair value gap, and then it's going to take out this sell side liquidity point, which is going to be relative equal lows or equal lows. So equal lows and equal highs in the retail logic standpoint, or in their world, this is known as double tops and double bottoms. A double top and a double bottom. They believe when price runs to equal highs, also known as a double top in retail patterns, they believe when the price comes back up into this equal high or this double top, they believe it's going to reject down lower. They don't believe it's going to get taken out. With us, we know what price wants to do. Why? Because there is liquidity sitting above these equal highs. What is liquidity? Buy stops. Price sold. So a lot of retail traders that are in short here, or that saw that they had this big run here, when price started to come up, they said, oh, this is a retracement right here. I'm going to enter right here, put my stops right above the most recent high right here. They have to put a stop loss order for their short order. So a stop loss in a short order is known as a buy stop, which are above highs. So because there's buy stops, that's liquidity sitting above these highs. So when the market comes up and takes out these highs, this is added liquidity back into the current price. So price is going to come up, take out all of this liquidity here, and it's going to reject down even more impactful than it did originally because it has added liquidity now. So just remember the two types of engineered liquidity, right? Two types of engineered liquidity. We have trending down buy side right here, where we have buy side liquidity. If we are bullish in this instance, right, we have buy side liquidity that hasn't been swept, trending down buy side that hasn't been swept, or we have equal highs like that, yeah, that hasn't been swept yet, yeah. So liquidity that didn't get swept yet, it's either buy side liquidity that didn't get swept and is trending downwards, creating a higher low or lower highs, or it's going to be equal highs and equal lows. Okay, that is basically what engineered liquidity is. Now, number 3, this is going to be difficulty of willingness to go higher or lower. Well, now, what does willingness mean? When someone asks you, can you go to the store and get me, like a 6-pack of beer or whatever, and say you're tired because you went to the gym or something, or you had a hard day of work, do you have the willingness to go to the store and get your friend that thing? Probably not. That's the same thing like the market. The market's not going to want to go any higher or go any lower if you're bearish. So if you're bullish in this instance, you are not going to want to go higher. And also, let's bring it back to the first step as well. We swept external liquidity. If this right here was an external buy side liquidity and we swept it here, this is our new swing high here, and we did not create any engineered liquidity on the way back down to tap into this higher time frame PD rate or sweeping sell side liquidity. We had not generated any engineered liquidity, and we had swept external liquidity. So because we swept external liquidity at the highs, and this is our new swing high, this is our only target. On the way up, there is no other liquidity point for us to mitigate. So it is going to have a hard time, or it's not going to have the willingness to go any higher to this buy side liquidity level. So when we talk about price does not have the willingness to go higher, that means price is not wanting to push any higher on its own without generating its own type of liquidity. Now, what type of liquidity would that be? That would be either buy side or sell side to be taken out. But preferably, it wants to be sell side. Why? Because we're on the buy side. We're in a buy program. And just to introduce you to what a buy program is the algorithm spooling to the upside, wanting to nothing else but do, which is going to be going higher. So when you talk about a buy program, price is going to go higher no matter what. No matter what. So when you got a buy program, right, and price is going higher, and then say you got an unmitigated fair value gap down here, price is not going to come all the way back down just to mitigate that fair value gap to go higher. It is going to continue going higher no matter what. So when we talk about a buy program, yeah, we might have fractal fair value gaps. Those are the fair value gaps we want to be targeting. But price is not going to go into deep retracements. It's not going to go to order blocks. It's not going to go to these breaker blocks. It's going to go into these fractals, and it's going to continue going higher because it's in a buy program. So when we talk about high resistance liquidity runs, right, price is in a buy program, but it does not have the willingness to go higher because there's no engineered liquidity and there's no liquidity points Also, there is no inefficiencies or major inefficiencies to grab liquidity from. So what it needs to do, it needs to create its own liquidity. How else does it do that? It's going to have to create short-term highs and short-term lows, intermediate-term highs and intermediate-term lows inside of this range from this high and this low. So this is our range, and price needs to create liquidity inside of this range for it to go higher because it needs fuel. So imagine a car, if it's going from point A right here all the way to point B, right? And this is 100 miles, and you only got 90 miles in the tank, right? And you have two routes. You either can take this route, and there's a gas station right here, and there's a gas station right here, right? You can either take this route, gas station right here, gas station right there, and then you can get to your destination, or you can go through this route, which is 100 miles, right? But you only got 90 miles in the tank, but there's no gas station. So if you're talking about this in a metaphor with a car, are you gonna go the route where it's a little bit more choppy, it's a little bit more dangerous, but you get a gas station and you're not gonna get stranded in the middle of nowhere? Or are you gonna take the route which is going to be no gas station and from straight point A to point B, and you don't even have enough gas? The market is going to go in this direction. So you need to understand high resistance liquidity is going to dance a little bit. So when we talk about when we're in our live trading, right? And we're trading live. Whenever I'm talking about price is dancing a little bit and I'm not liking it, this is what I'm talking about. We're in high resistance liquidity. I do not like trading high resistance liquidity. You can be in a trade for like 2, 3, maybe even 4 hours, and you aren't going to nowhere. You are literally going nowhere. Price is dancing. Price is trying to go up, and then it goes sideways, and then it comes back down, sweeps liquidity here. Now it's coming back up, has a market structure shift. Now it's having a deep retracement back to this order block here. And it's just dancing. It's literally going nowhere. It's literally consolidating the whole time. And that is why high resistance liquidity needs to be identified before you even enter a trade when you're in high resistance liquidity. Because when you are in a trade in high resistance liquidity, you need to basically endure all of that anxiety of price pulling back on you, and you need to endure all of that anxiety of price not going in your favorable direction super quickly. So let's move on. So to number 4, right? So we're going to number 4. There's going to be lots of pullbacks into bullish PDRAs, okay? And this is going to be the retracements that I have been talking about. So when we talk about deep retracements or short-term or fractal retracements, we are looking at price retracing into possible bullish PDRAs. So we sweep liquidity here. We have a sell-side liquidity sweep, but maybe we tap into an order block right here with this retracement right here. Okay, that can be a bullish PDRA retracement. Okay, price might retrace into this bullish breaker. Okay, price might just retrace into an order block. Whatever. But when price is respecting bullish PDRAs, but it's retracing consistently into bullish PDRAs, that could be a possibility that price is going to have high resistance liquidity. So when we talk about high resistance liquidity, if price is coming up, price comes back down into a fair value gap, fills it, breaks structure, and then maybe comes into this fractal fair value gap, and then it comes down into this original fair value gap, and then it comes back up, comes down into this breaker here, and then comes back up just a little bit, and then comes down into this other fair value gap, and then comes back up. You see what I mean? It's constantly retracing into bullish PDRAs. So because when we see this type of stuff, we can anticipate that this could be high resistance liquidity run because price is consistently retracing into bullish PDRAs. Okay, so that's another thing we can look at. And finally, if we are taking out internal buy side and sell side liquidity. So what is that? What is internal liquidity versus external liquidity? Now we need to go back to our original roots of this mentorship program. Again, back to market structure. What is external versus internal? External is going to be a trading range. So this swing high to this swing low. That is going to be external right there. Internal is everything that is in between. Okay? That is internal. So we got external here and external there. So we got external sell side liquidity here. We got external buy side liquidity here. And this is our externals, our external buy side and our external sell side. Sell side. Everything in between is going to be your internal liquidity points. And this is going to be PD raise, and this can include buy side and sell side liquidity internally. So when price takes out sell side or buy side internally, that's going to look something like this. Price creates sell side liquidity here, market trades down, sweeps this sell side, and then we have a market structure shift internally to then retrace higher, basically, or not retrace but continue higher to our designated target, which would be our external buy side. Okay, so overall, what is high resistance liquidity? It is basically market conditions that are not favorable to be pushing higher or lower, but it will reach higher or lower eventually. It is just not going to do it super fast. It is going to take a long time. Price is going to dance in there, and you're going to have to endure a lot of anxiety because of pullbacks, okay? And how do we know what high resistance liquidity and when will it happen? These key factors here, okay? So 1 through 5, we look at these key factors. When we look at these key factors here, we can anticipate high resistance liquidity possibly happening, okay? Now we'll move on to low resistance liquidity, okay? So take a look at high resistance. Now take a look at low resistance. Okay, so you see the difference between high resistance and low resistance, okay? So low resistance liquidity is basically the opposite of high resistance. Price is going to go to its intended target super fast, no question about it. Very minimal pullbacks, maybe even zero pullbacks, and it's just going to shoot straight off to its designated target. This is the type of market conditions I love to trade in. Low resistance liquidity runs because it's fast, it's explosive, it's super quick, it's right to the point. It's like a bullet. It's like literally a bullet going straight to its designated target super fast. I love these conditions, and when you are on the right side of the market and you got an entry on these, you will basically pretty much have a very, very huge trade. Pretty much almost every single time this happens, you'll have a very good trade. And even with low resistance liquidity runs, if you catch a fractal entry, which are not high probability entries, you can get stopped out on those a lot. You can basically pretty much dub almost every single time on fractal entries because of low resistance liquidity. So, number one, how do we pay attention? Okay, guys, pay attention to low resistance liquidity, okay? So, how do we know when low resistance liquidity could possibly be forming? Number one, price has a quick, explosive, sharp, and efficient moves. What does that mean? Price is fast. It gets to its designated target under like an hour, 30 minutes, 20 minutes, 15 minutes. It gets there so fucking quick. It's literally so quick. It's like a fucking bullet. It's literally so fast. It gets to its target. It's done. Objective is out of the way. Now it creates a new objective and a new intention of what the market wants to do for itself, okay? So that's the number one. Number two, price has engineered liquidity to be taken out. So when we talk about engineered liquidity again, remember, price had taken out this buy side, but what is it doing on the way down? It's creating more buy side to be taken out later. Tap into a higher time frame PD, or we sweep sell side liquidity. Now we have buy side liquidity to be taken out. Remember what we talked about? Engineered liquidity. We created equal highs. We also created trending down liquidity to be taken out. So we got equal highs here. Price creates equal highs here. Algorithm creates equal highs. Why? Because retail traders are going to think that we are short here. They're going to put an entry, right? They're going to put an entry right here maybe. Or maybe they're going to put an entry at the high, put their stop loss above it, and then they're going to get stopped out here, added liquidity here, and it's going to give us an extra boost to take out that buy side external liquidity there. So engineered liquidity to be taken out. We got trending down buy side liquidity. We also got equal highs. That is engineered liquidity for us. All right. So two things: engineered liquidity and sharp, efficient moves. Okay. Next thing, fake retail patterns to be taken out. Trend lines, flags, wedges, triangles. Okay, what do we got that's a retail pattern here? We got trend lines here. We got a trend line here. Not a very good trend line that I'm drawing, but basically a trend line is basically when price is going higher and it creates a line like that at the highs, or when prices are going lower, price creates a straight line lower, because if price is respecting this line that you drew, market didn't draw this line, you drew this line. If the market is respecting this trend line of yours, then obviously it's going to continue going lower and it's not going to go higher, right? Wrong. Wrong. Totally fucking wrong, right? So, basically with trend lines, it is a retail pattern. You drew that pattern, nobody else drew that for you. It is not part of the market, you drew that. Okay? So retail patterns do not work. You see in this example here, right? We created trend line liquidity here. We also created equal highs. That's a double top. That is a retail pattern as well. Does not work. Or markets know their stop losses above here. Retailers go short here because they think price is bearish in this instance. We are not. We are still bullish. We want to target this external buy side. So we take out equal highs. We also take out the trend line liquidity as well. So because of those two things, retail patterns are another thing that can indicate to us low resistance liquidity. Number 4, it has easy willingness to go higher or lower to external liquidity levels. What does that mean? That is very fast, energetic moves, and it's getting there quickly. It is not taking a fuckload of time just to get there. It's not taking 5 hours to get there. It gets there in like 20-30 minutes. Super fast, super efficient, not wasting any time. It's going to its designated target that price wanted to do originally, and there's no question about it that it's doing that. Okay. Now, number 5, there's very minimal to none retracements and pullbacks. That means there's very little pullbacks. Here we have one pullback. It's very minimal. Minimal pullbacks to 0 pullbacks to get to its target. So that means when you are in a trade here, or you're not in a trade, anytime you get that pullback, you get that fractal entry pullback, you're going to want to enter on that fractal. You're not going to wait for that full optimal trade entry, equilibrium retracement. You're going to want to get that fractal entry. Compared to here, you see how many pullbacks we have. We got 1, 2, 3, 4, 5 pullbacks. That's a lot of pullbacks. Here we only got 1, and then we go straight to buy side liquidity. So these 5 things can indicate to us that low resistance liquidity could possibly happen. Okay, so when we spot these things, we can anticipate low resistance liquidity to be happening. And again, if we end up in high resistance liquidity conditions, you just got to endure all of this pain. Now, another example of low resistance liquidity is going to be the retail patterns like this, which is going to be trendline liquidity, and this is representing a pattern called a bull flag. Okay, so a bull flag, what it'll look like a retail pattern, it's going to look something like this. Price is going to do this, and then it's going to create like a flag pattern, which is going to be like that, and then it's going to go higher like that. It's also known as a bull flag. What does price do here? Creates a bull flag here. Price just digs down, and it just doesn't work out, right? So because of that, this bull flag, it's irrelevant. It's literally irrelevant. And what's also funny is retailers will see this as a breakout trade. They'll see this as a retest, come down, tap into this higher time frame PD array, and then it'll become bullish again. Why? Because that's where liquidity is. This is where liquidity is. Liquidity, liquidity. All of the liquidity down below these lows, that's all liquidity. But retail traders do not understand that. So bullish flags or bearish flags, wedges, triangles, they do not work. Okay, so you want to understand that when you have these retail patterns like these wedges, or you got double tops which are equal highs here, or you got trendline liquidity, anytime you got any of that type of stuff, you always want to pay attention to what your basic market structure is doing, which is going to be your breakup structure, your liquidity sweep, your higher time frame PD raise, your internal PD raise, internal market structure. You want to pay attention to all of that to see what it's doing, because whatever that is doing is going to be the opposite of this, and I can promise you 99% of the time that's going to be the opposite of this. Okay, so Here we're going to be paying attention to an example on the charts of what low resistance liquidity looks like in with candles, okay? So you see here we engineer liquidity on the way down, right? We engineer liquidity on the way down. And when we're engineering liquidity on the way down, we're creating buy-side liquidity that had not been swept yet. So because we engineer buy-side liquidity on the way down, this is targets for us to then take it out, okay? We sweep liquidity down here. Market trades up, dances a little bit at the beginning, at the bottom. But once we take out that first buy-side liquidity, we retrace back down into this fair value gap, also retracing into this breaker block. So if we mark this out here, we retrace into this breaker here, taps into the breaker. What does it do right after that? It just literally explodes off to buy side liquidity. Zero retracements, zero question, zero. It just literally just shoots off, takes out buy side liquidity here, and it's literally it's over. The trade is over. The whole move is over. And this is in a span of what? We got 10 o'clock here. Gets to buy side liquidity around 1 o'clock. That's about a 2-3 hour trade on the 5-minute time frame. And if we compare that to a high resistance liquidity run, and we start here, tap into a higher time frame PD ray. This is high resistance because we swept sell side liquidity here. We swept sell side liquidity here. And if this is our new range because we tapped into a fair value gap here, this is our range right here to here. We need to get to this designated area. For us to do that, we need to trend all the way back down. And this trade, this whole process, this whole thing takes place from, what do we see? 10:30 all the way to 9:30 or 10 o'clock p.m. right? That's a long trade. That is a long trade. I do not want to endure that, and that's on the 5-minute time frame. Okay, so that is on the 5-minute time frame. I don't want to be in this type of conditions right here. Just having super small candles, a lot of pullbacks. I don't want to be in that. I want to be in this type of condition where we just shoot off straight to our objective, no questions asked, and we just go there. No questions asked. Okay, that's the type of conditions I want to be in. That's the type of conditions you want to be in as well. When we talk about high resistance, we can be in these conditions. It's just going to take a longer time to get there. Okay, so understanding what high resistance liquidity and low resistance is, that'll make a difference in pretty much your trading. Okay, and I know you guys saw me swip to this slide here. Basically, this is going to be going over chart patterns and how they do not work. Okay, and I know a lot of people that basically trade retail. They're gonna get mad at me and saying, "Oh, you're cherry picking this, you're cherry picking that." Yeah, I am cherry picking. Why? Because there's a lot of cherries to pick. Okay, so retail patterns do not work. We will look at this from a retail eyes. Okay, if we're trading retail. Boom, rising wedge pattern. What does a rising wedge pattern look like? That's a wedge formation like this, right? And it's usually a bullish wedge. Once we get that breakout out of this line that you drew, this breakout, you usually are going to go long here. Stop loss below the next line, which is going to be a trend line, right? Yeah, this isn't going to work. Why? Because we get stopped out here. Boom, get stopped out. Now you're all salty. Don't trade retail. Okay? This does not work. This does not work. When you take this and you put it into the eyes of an ICT trader, this is what you're going to be looking at. Same price action, same candles, different narrative. This is a rising wedge. Enter here. Maybe get a 1-to-1 trade here, or you can try to get to a 1-to-2, but you're not going to get there. Why? Because you're going to get stopped out. This is the idea of a pretty much retail trader, a pattern trader. This is the eyes of an ICT trader. We can see a 2022 model that formed. We swept buy side liquidity here. We had our market structure shift. This is our swing high, previous swing low, displacement through that swing low. We get that mitigation of this fair value gap right here. Then we trade all the way down to sell side liquidity here. This is our rising wedge pattern, apparently rising wedge right there. But we just see this as liquidity. There's no structure, nothing. There's no market structure shift at all. There's just liquidity that built up. It's a buy side liquidity pool here. So what do we see this as? It's just liquidity that got built up, and we have a OTE retracement from this swing low candle here and this swing high candle here. So from this swing high all the way down to the swing low. And from there, we have an OTE retracement between the 0.618 and the 0.79. What type of PD rate is in there? Boom, an order block that didn't get tapped into. Once we tap into that order block, we enter right at the open of the order block, which is going to be probably right here. Or you guys can enter at mean threshold of the order block, whatever. Or you guys can enter at the open of the order block, which is going to be at the bottom. It's totally up to you guys, but whatever. You enter on the order block for a short. Put your stop loss above the order block. You gotta, even if you trade it down to this leg right here, just this whole leg right here, that is basically, if you entered right here, stop loss right there, that is like a multiple of that's like a multiple of 1 to, that's like a 1 to 3 right there, or even a 1 to 4 depending on how you placed your stop loss. Okay, so that's a 1 to 4 trade, literally a 1 to 4. You compare that to our chart pattern here, right? This is literally bullshit. I do not believe in chart patterns. And Pona, you're being so biased because you trade only ICT concepts. No, you know what I tried before ICT concepts? I tried trading retail. Retail doesn't work. I don't think I ever had a 1 to 2 risk to reward trade. Like, ever. I don't think I've ever had one. Literally, I've never had a 1 to 2 risk to reward trade with retail patterns. Why? Because retail sucks. It fucking sucks. And literally, they're literally going to explain retail patterns as, oh, it works for me. Okay, it works for you. Good. It doesn't work for me, and that is definitely not how the algorithm works. But if it works for you, good for you. But for me, no, that does not work for me at all. And I can tell you, millions of other people that tried retail patterns, they just lost a fuck ton of money. So, in my opinion, if you want my advice, do not trade retail patterns. This will get you stopped out, and it is literally going against ICT. It's literally going against ICT concepts here. And literally, every time you trade ICT concepts, retail traders are trading in the opposite direction of you. They're literally trading in the opposite direction of you. And it's literally so funny that people think that, oh, people that trade ICT is literally, it's literally just analysis paralysis, or it's too much information, or you're literally having too much on your charts or whatever, or it's too advanced and it's not necessary for that, and you can just keep it simple like this. Nah, you want to keep it simple like this? Good for you. Go ahead and get stopped out for all I care. I really don't care. You want to start winning trades, okay? You want to understand how the market works, right? Trade ICT concepts, focus on the basics, then move up your strategy a little bit by little bit each time. And after you do that, you will eventually get to the point where you can, start being profitable. And remember, your strategy does not make you profitable. What will make you profitable is your risk management, okay? That's number one, following your risk management plan. So that goes out the window as well. So strategy is only 10%. Psychology is literally everything. And risk management is up there, but you can't follow your risk management plan without your psychology. So understanding that you need to follow risk management, and you need to basically strip your mind of all negativity, and you need to literally sharpen your mind to follow yourself and follow your plan so that you can eventually become profitable in the markets because of following your risk management plan. And you follow your risk management plan because of how good your psychology is, okay? Other than that, I hope you guys found this video helpful, and I will talk to you guys later.